The retirement savings credit is actually a really easy credit to calculate compared to a lot of the other ones that we've been working on. It is also known as what we call the saver's credit. So we're saving or investing money. So it's also called the saver's credit. Your book doesn't have a lot of information about it. Unfortunately, you'd almost have to Google some of it to find some information, but there is an age limitation. You have to be, I believe at this point it's still 18, so we can't do this on our young working people. There is an income amount, so we do have to have some income. And if there is, your book does mention it, if there is distributions, we have to subtract those from what we'd be able to claim. But it is a really cool credit. There's specific accounts that you can use. IRA is the most common one. It's an individual retirement account, but there's a list of additional ones you could use to invest in and still qualify. There's a maximum amount, and that I want to write down. It's right now this year in 2024, which it's been this for a while, so I'll keep this video as long as it's still the same, but it's $2,000 is the maximum. It's per person. But what we do know is that it is a percentage. So the maximum contribution that you can save, so we'll call it saving, the maximum savings is $2,000 per person. But then from there, it's a percentage. And we use Form 8880. And here is a little snip of it from your book and also from the actual form. This does change every year. So this is the 2024 table. And for the most part, though, these ranges are pretty, they try to keep them pretty similar. Basically, we have 3 different categories for filing status. So we have the joint returns, anyone who's filing a joint return, and so we'll look at these numbers. Head of household, we'll look at these columns, these sets of ranges, and then for the all others, which is pretty much our single people, they'll fall into here. And then that last column, those are the percentages. So as we work through this, we'll go through each problem. You'll see it's a pretty quick one. The percentages, wherever they fall in the range, that's the percent we'll use. All right, let's move up to our first example, letter A, a married couple. So we're going to use those first sets of columns. So we're married, filing joint. Their modified AGI is $37,500, and they're contributing into their IRA $1,600, $1,600, which is less than the maximum, so we're good there. So here's what we do. We write down how much did they save, how much did they invest, right? We're going to call it save. So they saved $1,600. Now what we'll do is we'll multiply it by a percentage from the table. So let's go down to the table. Their modified AGI is $37,500. So let's look at this. They would fall in that very first row. So 37,500, they're falling right here in this first row, which if we look over to the side here, that would be 50%. So they get a credit of 50% on their tax return for saving $1,600. So their credit that they're going to get is $800 credit. So pretty good deal there. Awesome. All right, the next one is also married joint, so we'll look at that one. Their modified AGI for this problem is $58,000, so they're higher, and they're contributing just $1,500. So, and it's per person would be $2,000 allowed, so they're definitely under that. Yep, they're falling in almost the top one. I shouldn't say top because it's actually one of the lower ones, right? So percentage-wise, they're falling in that third row, which is 10%. So they're going to get 10%. Now for a lot of these tax returns, let's go back up here, let's write this all out. For a lot of these tax returns, what happens is we do their full tax return, and at the end we say, oh, okay, you owe money this year. But if you contribute, because they can contribute up to the tax return date and still count it in the prior year, if you contribute some money into a qualified retirement account, you can save a little bit of money. So take a little bit off your bill. So instead of paying the government, you can pay yourself, save it in an investment account, and you would get a little bit of a credit. Now in the 10% range, that's not such a great deal, but under letter A, that's a really good deal for them. Hey, just take $1,600 if you have it, and you'll get $800 off your tax bill right away. So you're basically giving yourself the money. So yeah. All right, the next one. Head of household for this one. So that means we'll use the head of household columns. Their modified AGI is $32,000 and they're going to save $2,000. So a single person, $2,000, that's the maximum. So that's great. So we're going to say, all right, let's save this and let's look at the table. If I see a head of household, I see that they fall in the very first row, which is the 50%. So they'll get 50% of whatever they saved, which means they get a $1,000 non-refundable credit. So let me explain what this would mean. So on the tax return, if I had this particular taxpayer in front of me and I did their tax return and I said, oh, you owe money. You owe $1,000 into the government. I did everything. Your choice would be pay the government the $1,000, or you could pay yourself $2,000, put it into a retirement savings account. That would give you a $1,000 credit, and then you could take that off of your tax bill and owe zero, owe nothing. Now again, it's non-refundable, so you're not getting any money back. In this case, you have to have owed money in order to get this credit. You'd have to have a tax liability. And this last one, I don't love this example because it's kind of unrealistic. It is a single taxpayer that's only made $18,000. So looking here at our all other filers, because this is where single will go, $18,000, they definitely fall in that first row, so 50% off. Now I say it's unrealistic because the contribution that they're talking about is $2,300. Honestly, someone who is only making $18,000 for the year, after taxes, after living expenses and everything else, I don't imagine they have $2,300 sitting around. So this might not be one we see in real life, but it is a good one to practice because right away we see that yes, they saved $2,300, but maximum for one person is only $2,000. So we right away have to crunch that down, 50% off, or I'm sorry, 50% credit per the table. And that means they get a $1,000 non-refundable credit on their tax return. So that is wonderful, right? So one thing to remember is that they can do this savings, they can put this money into a qualified retirement savings account up until the due date of that tax return. So if we're doing 2024, they can save this money up until 2025, April 15th, 2025. Same thing if we're doing 2025 tax return, they can save it until whatever the due date is for April, whatever date, 2026, they can save it. That's why we do the tax return. We figure out how much money they owe, and then we offer them the ability of, hey, would you like to put this in a savings account and get this credit? It's a great tax strategy. So that's the Savers credit.